It's okay.
Okay, so have a restart then. What you see is here that you have this very explicit form. And how did I get this? Well, I got this form by looking at the final wealth and then guessing that the final wealth solves a certain differential equation. And this was on the visualizer here, where I have this form of my final wealth, and then I write down the equation that it satisfies, then I write down the equation for the wealth in the usual way, and then I just compared the coefficients here. And this can be made much more formal, and this is the usual way how to get the optimal strategy. Because if you look in the literature, there are two methods. First is this comparison of coefficients that I've given you, and the second is a so-called feedback representation in the Markovian case that uses ideas of Malliavin calculus and others. And this is quite complicated, although it's mathematically very nice. So I only want to give you that theorem that more or less, I would say, formalizes what I have done. If my final wealth and the optimal consumption can be written as a function of the underlying Brownian motion, then I can explicitly compute the corresponding trading strategy. That's all, right? And this is just a formula where you can plug in everything. As soon as you have this function f here, everything else can exactly be read off. But that's more an example that you could use for other utility functions like the 1 over gamma x of x to the power gamma function. Now the second approach that I would like to show you is the so-called optimal investment by stochastic control. And this is something that is much more general. The first approach was related to the completeness of the market. This approach is something that came from, well, technical motivation, from steering a plane or tuning a radio or whatever. That is the stochastic control approach that is more engineering based. And the main idea of Robert Merton was he realized, oh, there is some methodology. Where is the stochastic control problem in my investment? And of course, you cannot steer the stock price, you cannot control the stock price, but what you can do is, you can control the evolution of your wealth by fine-tuning the portfolio process pi and the consumption process c. So Merton more or less said, okay, I have identified my investment problem as a stochastic control problem, and then I just go to the shelf, I take a book about control problems, take the methodology that I have there, derive the so-called Bellman principle, derive the so-called Hamilton-Jacobi-Bellman equation, and this can be used as a kind of cooking recipe to solve those problems. And I will give you a very short and incomplete introduction to stochastic control. Okay, there's the first thing. So instead of looking at just a single problem, and I forget about consumption for the moment, this is my final wealth. I want to maximize the expected utility from final wealth. And if I would start at time 0, this would be my problem, my portfolio problem. And now I'm looking at a whole family of problems, because I parameterize this by initial starting time and initial wealth that I have here. I'm looking this as a function of the starting time and of the initial wealth. This is the so-called value function. Now, here's the first thing. Here is the so-called Bellman principle. And why is this valid? Let me draw you a picture. Think again about our investment problem. Here is my time t. Here is time 0. Here is my initial wealth of x. Now, what I would like to have, I would like to be here, and I would like to solve this problem, Vt of x, which is maximize over all pi restricted to t, capital T, the expectation if I start at time t with x, and let's make it a t here, at time t of x with an initial wealth of x, and I would like to maximize this. Now, if my small t would coincide with the capital T, then of course at that time I already know what is optimal because there is no possible change here, there is no randomness. This is just given. At the final time everything is fixed, that's it. Okay, now assume for the moment, and let's still have a 0, come on, let's have a t here. Assume for the moment that I can get to my time s. And assume for a moment that I know Vs of x of s. Assume that this is known. What does this mean then? Then it means if I'm here at that point x pi of s, if I'm here, I know how to go from here in an optimal way. This is what I know. I know how to go from here to there in an optimal way, and I know what the utility is that I get from that point. Okay? Now, the question is, if I know how to go from here to there, what remains is just to find a pi which is restricted on time t to s. And then if I start here with an x, I get this here. What I get is, I get an, if I start from here, I get a vs x of s. Now, if I want to have the optimal strategy, vt comma x, this is how I can get in an optimal way from here to there, but I already know how to go from here to there. Now the idea of Bellman's principle is just, well, maximize over all those pi between t and s, and start in time t with initial values of x, but you know at time s you get this, so you replace that utility function by the value function. This is called Bellman's principle. What's the advantage of Bellman's principle? You have reduced a big problem to solving smaller problems. This is a shorter time instant. Now, if time would be discrete, you could move in step by step from the back to the front. But we are in continuous time. There is no step-by-step movement. But in continuous time, the nice thing is we have a lot of mathematical methods that we could use. So we could so-called localize this principle, because if we look at this here, this value function is known. We only assume that this is known. This is much more complicated than this. So the problem is more complicated. But what we're doing is, as we assume this to be known, we apply Ito's formula to it. And if we apply Ito's formula to that, then we get this point here that we can take out of the expectation. We get this and this. And then we can start in manipulating things. We assume that this expectation is 0. Then we divide by s minus t. And we subtract these two sides. So we have 0 on the left. We can divide the 0 by s minus t. It stays 0. Then here, if we divide by s minus t and use the mean value theorem, let s go to t, then formally the expectation can be left out because only this thing inside remains and there's no randomness at all, and we get this equation. This is a very, very formal and heuristical derivation. This cannot be justified. But the nice thing is, I can prove a theorem that includes this equation in a totally different way. And that is the basic theorem, the so-called verification theorem for the solution of the Hamilton-Jacobi-Bellman equation. It says, if there exists a sufficiently differentiable solution, a classical one of this year, that is polynomial bounded, then we have that this solution coincides with the value function, and if there exists an admissible portfolio process, pi star, that yields the optimum here in that equation, then we know that it's an optimal portfolio process. And how do I get this equation? It's quite easy. I use the Wells equation. I take the term that multiplies the Brownian motion and square it, more or less. I take the term that multiplies the dt term multiply it with the first derivative of mu with respect to x. Here, the squared one has to be multiplied with the second partial derivative with respect to x. I add this. So it's like a cooking recipe how you obtain the HJB equation, and that's the final thing. Now, what's the importance of that theorem? The main importance is that from that theorem, we get an algorithm how to solve portfolio problems. So the first thing is, if we have set up this equation, then the first thing that is really hard is this supremum operator. And we get rid of the supremum operator if we just formally maximize this with respect to pi. Now, do we have hope that we can do this? Yes, we have hope, because as a function of pi, it's just a quadratic form. And if you're in dimension 1, then it's just pi squared times sigma squared x squared, multiplied with the second derivative of a maybe concave function. Then you have a parabola which is open to, which is downstairs open, so it has a unique solution. You plug that unique solution in, and then you solve the equation here without the supremum operator. And this sounds easy, but it is not easy at all. And there is a third step, and the third step, and I feel this is very important, is you should check all the assumptions that you made during your computations in step 1 or 2. Like saying this is concave, the optimum exists, and so on. And why is it so important to have this third step? Now, mathematically, this is very complicated, but it hides a very simple fact. It is the same as if you want to maximize a function. And if you're looking at the first derivative, you set it equal to 0, and then you find a unique value, and then you say this is the maximum. No, it's not. It might even be the minimum, right? You have to check that indeed all the assumptions you made are satisfied. If the function is concave, if it has a 0 of a derivative, then this is indeed the maximum. But if the function is not concave, if it's convex, it's the minimum. If it's neither concave or convex, it might be neither minimum or maximum. Here, it's the same problem. It's only a necessary condition, not a sufficient one. You should really have to check if all the things you assumed are satisfied. And I will do that during an example. So this is my example. I would like to solve that optimization problem here. And now I'm going through all the steps that I introduced. I would like to maximize the utility from final wealth, and I use this HARA. HARA stands for hyperbolic absolute risk aversion. These are those functions here. If you look at the quotient of a function by x times its derivative, this is a hyperbola. This is more or less 1 over x. But that's a side remark. So here's the value function. Here is the corresponding Bellman equation. And once again, how do I get the Bellman equation? Here is the cooking recipe for the Bellman equations. If I have maximized expectation u of x of t over all kind of pi, and if I have that dx of t is equal to x of t times pi t times b minus r plus r dt plus sigma times pi of t dwt. So how do I get the Bellman equation? Well, I take this part here together with this. I put a 1/2 in front of it. I square it, sigma squared, pi squared, x squared, and I multiply it with the second derivative with respect to x of the value function. Then I take, well, this part here, again with this. I have a pi times b minus r plus r, multiply it with x, and now I'm multiplying it with the first derivative of the value function. And as I have a finite time horizon, I have to add this here, set this equal to 0, but I have to take the supremum over all possible pi, and I have a final value which is equal to u of x. So it's really a cooking recipe how to set up a Jacobi-Farman equation. It is not that setting up the equation is the main problem. Okay, now I leave it here for a moment. Now, if I have set up this equation, which I did on my PC, I did this now in multi-dimensions, therefore I have a pi transpose sigma, sigma transpose pi here, then I should solve it. Now, first of all, I have replaced this pi in a prime of x by pi of ab to the power n. Why this? Now, pi element a prime means I should end up with a non-negative Wells process, with non-negative Wells. And for ensuring that, I now say, well, I assume that my pi lies inside this n-dimensional interval. And this a and b is not chosen at the moment. This is just free. Yeah? And I have to comment on that later on, how I get rid of that. So first step, solve the maximization problem in the HJB equation. Now, if you look here at the visualizer, and I'm assuming that my pi is AB, then you see, as a function of pi, here's a linear pi, here's a square, I can just set the first derivative with respect to pi equal to 0 if I assume that this thing here is negative. Yeah? Then just take the derivative with respect to pi, which is very easy, and you get that formula here, this one. Okay, but it's important, I have implicitly assumed the following things. This is smaller than 0, and this optimum is inside this ABN, and I have assumed that the nu, the value function, is C12. All these three things have to be checked afterwards. Otherwise, I might have ended up with having computed a minimum expected utility strategy. The second thing is I put this thing into equation 22 and I get this equation. Oh well, I have to solve it. And I make the following ansatz. Those equations can rarely be solved. If you go to someone doing PDE, he says, oh, you get no chance at all, right? And we're quite lucky that here we can solve that. We know that at the end, we have the function 1 over gamma x to the power gamma. But now we're not at the end, so we hope that there is only a correction for the time value. And so I just plug that in. Now if I'm plugging that in, this has some consequences. As I'm plugging that in here, you see a lot of things cancel out because mu x has an x to the power gamma minus 1. Mu xx has an x to the power gamma minus 2. Now there's x to the power 2 gamma minus 2 divided by x to the power gamma minus 2. So there's an x to the power gamma. Here's an x to the power gamma. Here's an x to the power gamma. So you can really plug that out. And what remains are all different f's and f primes. Here's an f prime, here's an f, and here's an f. And you have this simple equation. And this is an equation we can solve, right? Because that's easy. That is something we know. And now we end up with a lot of things. First of all, we can compute this. Why can't we do that? Well, we can just plug in what we had here. The x to the power gamma cancels out, and only the f, no, the f is not in there. It also cancels out. We only have the 1 over gamma here. Otherwise, this is our candidate for the optimal portfolio process. And now, we would be finished if all the assumptions we would have made are indeed satisfied. So we check them. Okay, this satisfies star. And what is star? Star is this here, because it's x to the power gamma. This is twice differentiable with a negative derivative, and f was positive, so this is satisfied. The pi star t of x, and this is also satisfied, and the pi star t of x, why is this in a of b? Well, it's of course in A and B because I haven't chosen A and B. I can now choose A and B just large enough such that the pi star is inside, and then I choose them even larger and larger, and it still stays the maximum, so I can forget about the constraint. And therefore, I have verified that this indeed is the constant, or that these constant portfolio weights are optimal. Further, this is my Wells process, which is strictly positive. So everything here which I have done is indeed justified, and I have solved my portfolio problem. Okay, just for completeness, I now give you 3 more recipes. So what happens if I have consumption in addition? If I have consumption in addition, I just add a minus C here, because the minus C, remember, at the visualizer, remember how I get this. The things which are multiplied with dt, they occur as a multiplier here with nu of x. Now I have a minus c dt here. So the minus c goes into here. But I'm making a gain of u1 tc at time t, so I have to add that here. So this is just the new corresponding HJB equation. The way of solving it stays the same. If I have discounting in it, what happens then? Well, then the u1 here has to be replaced by u1 minus this discounting factor, otherwise the equation stays the same. If I have an infinite time horizon, which sometimes occurs in economic problems, the nice thing is that the time value stays the same, as the time to infinity always is the same, so there is no time dimension in the HJB equation. It's now, well, an equation where if you're in dimension 1, you are in dimension 1, it's an ordinary equation now, it's an ordinary differential equation. You've got no boundary condition, but you still have that polynomial growth condition. Oops. And more on applications of this, you will hear this afternoon. I think we're exactly in time now. So I don't know if there are any kind of questions or time for that.
Yeah, sure, it's time for questions. Anyone has questions? Let's see.
So what I should really say is, if you see that for the first time, it's quite frightening. And what you should really do is, you should really try to do both calculations for the examples I gave you. And then you see it's not that complicated at all. And the martingale method is something that you can use very often in the financial mathematics approach or financial mathematics setting. And that stochastic control approach is a really universal tool that you can use for whichever kind of control problems. And it always works the same. That sounds simpler than it is, because solving such an HJB equation can be quite tedious. This was the easiest kind of problem that I showed you, but it's always the same with that 3-step algorithm. Try to start with setting up the equation, and then in the first step, solve formally the optimization problem. In the second step, solve the resulting nonlinear PDE, and in the third step, and this is essential, in the third step, really try to justify what you have done before. There are many things in the literature where people have done the first 2 steps and have calculated a so-called optimal strategy, and in fact that was the worst possible strategy that they could calculate. And the point simply is, due to the complicated mathematics, people thought, well, we've done all that, that's it, but they didn't realize that very simple thing that I told you. It's only a necessary condition, and you can end up with calculating the minimum if you haven't verified that it's actually a maximum. Okay, that was a question.
Yeah, martingale approach is quite new for me. I was a little late, but you had the main idea of martingale approach and then in practice without consumption. So I get the impression this approach is only possible where you have a terminal payoff. You don't optimize payoffs evolving over time, or is that wrong?
No, it is just, I motivated that without consumption, because if you have the consumption inside, it's a bit more complicated, right? But the final result that I wrote down is of course with consumption, when you can also optimize payments where you get utility all over the time. That's the same. The only thing with the martingale approach is that in this form I have presented it, it's restricted to complete markets. It also works for incomplete markets, but then it's much more complicated. Then you need convex duality approaches and things like that. And this is very technical, but it also works for incomplete markets. The point is, if you look at the way the things are computed in the martingale approach, you always get the optimal final wealth very easy. You get a nice closed form for that, but then getting the corresponding strategy is quite hard. In the HJB equation approach, if we go back here, writing down the optimal strategy here is quite easy. Yeah? You just solve this problem here, which is a quadratic problem. This has a solution, you write that down, that's it. But to verify the exact form, you need this. But sometimes, with such an ansatz, you see already, you don't even need the f, because the f is in here and in there, it goes away. So a lot of people would have stopped after that. They say, okay, we make this kind of ansatz, and then we see, well, the f doesn't enter here, so we just stop here, we have the optimal strategy, but you haven't. You still have to do all the calculations to the end. But you get the form of the optimal strategy quite easy, but then getting the optimal final wealth is not that easy. You still have to solve for the equation and so on. Because here I haven't computed the optimal final wealth. You know, it's not so complicated here, but in the stochastic control approach, you typically get the strategy easy. In the other approach, in the martingale approach, you typically get the final wealth easy. It's the same, by the way, with option pricing. If you use the approach, the martingale approach, you calculate the discounted expectation under the risk-neutral measure. That's often quite easy, but getting the replicating strategy is complicated there. While if you use the partial differential equation approach like Black-Scholes have done, you might not be able to solve the PDE, but if you're able to solve the PDE, you directly get the strategy out of that. So that's the typical relation between both.
The martingale method works so well in finance because you use another ingredient, the arbitrage freeness. Is that correct? Because in the end you realize you have a martingale which you can replicate by trading strategy. I mean, in economic context, you often have an optimal control problem where you do not have arbitrage freeness. We have a growth equation, economic growth equation, and you want to maximize. There, you often don't have something like the arbitrage principle that discounted stock prices are martingales.
I don't think that you need the arbitrage principle. You need the completeness. Yeah? What you need is that you can really solve this infinite dimensional equation. You have the representation of the final payoff that you need. You need the martingale representation theorem. And you don't have the martingales here are only implicit. Yeah, you don't need to use the martingale properties anyway. So it's the completeness that is the good thing. In stochastic control, there is the notion of controllability in deterministic control that is in a way related to it.
Yeah, the interesting thing is that you see the Hamilton-Jacobi-Bellman approach in economics all over, but you never see the martingale method. But in financial mathematics, in option price or optimal portfolio, you often see the martingale.
I think the main reason for that is that in the 80s, when really the stochastic calculus entered the financial mathematics, all the people were people who did martingale representation theorems and things like that. And so therefore this martingale approach came in so prominently. And of course, if they would have started with an incomplete market, they would have never introduced it. And it took some time that afterwards, when they realized that an incomplete market's replication is not possible, that it's no argument, that they came up with such principles like superreplication and realized that superreplication and convex duality is related. So using convex duality is quite complicated, and I think it's even more complicated than solving the HJB equation, and therefore I guess that the HJB equation setting is still there. However, the HJB equation relies on the Markov assumption that you could summarize all the past information in just what you see today, and if you don't have a Markovian setting, then you cannot use the HJB equation anyway. So that might be an argument, but if you don't have a Markovian setting, it will be very hard for you to use convex duality and get a result. So it's like all over in mathematics. All the easy examples that can be solved in a much easier way than by using the general theory. But those examples that need the general theory, they are really hard to deal with. Okay, so then let me advertise a little bit for this afternoon. This afternoon we will look at investment problems when we can also deal with options, when we can invest into defaultable bonds, when we have possible crashes at the market. And what is so interesting here is like having those solutions like 60% in stock, 40% in bond. That sounds very nice and easy. But if you do that, at the real market, you have to trade at each time instant because stocks and bonds evolve in a different way. So at each second, you have to reshuffle tiny bits of your holdings, and the transaction costs will accumulate, and you will be ruined immediately. Not after a short time, immediately, right? And this is very hard, right? Being ruined immediately. I know that I explained that once in Berlin, and then afterwards a colleague came to me and said, well, immediate ruin, that's even harder than having a family, so I found that a very good comparison. And this is something I will show you how you can look at transaction costs, and transaction costs problems are usually much harder to solve, but I will show you a very simple approach that could be used in the end. And I might tell a little bit about optimal investment with stochastic interest rate, but I'm pretty sure that I will not do, because I've prepared a lot of material for this afternoon, and we might not be successful in going through this all, but that's not the point. So there will be some explicit examples this afternoon where you can see things that you normally don't see in the literature. And well, you got a long break now to recover. So hope to see you again now. And see you again at 1?
1:30.
1:30. At 1:30 in seminar room 1, right?
Yes.
Okay. Thanks.